In this section, we will discuss an accountant's liability to his or her client for causes of action like breach of contract, fraud, and malpractice. We're also going to discuss whether or not accountants have liabilities to third parties. Furthermore, we're going to discuss and explore an accountant's civil liability and criminal liability under federal security laws and discuss the duties of accountants under the Sarbanes-Oxley Act. Justice Berger of the United States Supreme Court in 1984, in the case of the United States versus Arthur Young and Company, he said, quote, "By certifying the public reports that collectively depict the corporation's financial status, the independent auditor assumes a public responsibility transcending any employment relationship with a client." In this section, we're going to focus primarily on those auditors, but let's expand a little bit about accountants' tasks and what they do, their primary functions. We know that they provide a variety of services to corporations and other businesses and nonprofits, but their primary functions are auditing financial statements and rendering opinions about those audits. Some other tasks, they might include preparing other types of financial statements, rendering tax advice, preparing tax forms, and providing consulting advice. But it's audits that generate the most litigation. When I say litigation, think of legal problems, cases filed against them. It's the audits that cause the most problems for accountants. They can not only be held liable to their client, but also in some cases they can be liable to third parties who've been harmed as a result of the accountant's conduct. A certified public accountant, or CPA, applies to accountants who have met certain educational requirements, passed the CPA exam, and have had a certain number of years of auditing experience. A person who's not certified is referred to as a public accountant. CPAs must comply with two uniform standards of professional conduct: the General Accepted Accounting Principles, or GAAP, and Generally Accepted Auditing Standards, GAAS. The Generally Accepted Accounting Principles are the standards for the preparation and presentation of financial statements. These are the rules for how corporations and accounting firms present their income, expenses, assets, and liabilities on the corporation's financial statements. Generally accepted auditing standards specify the methods and procedures that are to be used by public accountants when conducting external audits of company financial statements. The American Institute of Certified Public Accountants is the organization that sets these standards. Now, the generally accepted accounting principles, they're the standards that apply to both corporations and accounting firms, and the generally accepted auditing standards is used by the accountants. In the next video, we're going to focus primarily on auditors.